Wall Street's Titan is sending mixed signals. Now, on one hand, BlackStone's president, Jon Gray, predicts a bottom for the battered commercial real estate market, urging investors to go ahead and jump right in. But on the other hand, their own portfolio sings a different tune, with loan defaults, hotel bailouts, and a looming $160 billion crash in the sector. So is it a fire sale or a fool's errand? Buckle up, folks, because we're diving deep into this whole BlackStone paradox and what it means for your wallet. This video is your one-stop shop for deciphering the real estate whispers, unpacking BlackStone's strategy, and navigating the potential storm brewing in the market. So go ahead and hit subscribe and join the conversation, because in this game, insider knowledge is the ultimate currency. Appreciate you guys for hitting the like button for the video too. So here's BlackStone's president, Jon Gray, talking about real estate values bottoming. Just listen and see if you can really believe what he's trying to tell us here. Check this out.
You mentioned it a couple of times. The big open question in the market is how much more do real estate values have to fall?
So I think real estate values are bottoming here. It's not a V in terms of recovery, but there are some positive signs. I would note we still will see troubled assets that were financed in a different period of time. They're going to emerge over the next couple of years, particularly in the office sector. There are some areas like multifamily housing where there's a lot of supply and the fundamentals will be challenged as you look forward the next 12 months or so. But going back to this cost of capital, we've seen the 10-year move from 5% to 4.15%. We've seen spreads come down. That's very helpful for real estate. And new supply, new construction starts in real estate, particularly in our biggest sector, logistics, have fallen by something like 75% from the peak. That starts to create really the foundation for a recovery. Now, the way we think about this is things go down, they bottom, you bounce along here. Some sectors don't do as well. Some start to recover faster. The key for us with $65 billion of dry powder in real estate is to take advantage of this time.
This guy, the president of BlackStone Incorporated, he says to take advantage of this time, but at the same time, they're not exactly diving into the market themselves, as he admits himself that they're withholding about $65 billion of dry powder in real estate. Now, just to give you guys a quick idea, here's the decline in real estate values from their 2022 peak. The decline in real estate values from 2022 peak by sector: office, negative 35%, apartments, negative 30%, retail, negative 18%, industrial, negative 16%, new houses, negative 13%, existing homes, negative 6%. Basically, values down in every asset class. And before the BlackStone president incorporated, Jon Gray, comes for me, I just want to go ahead and point out how BlackStone is unloading, basically defaulting on some major properties from their own portfolio as well. So first, there's their 346-room club quarters San Francisco hotel that they're apparently trying to give up on after defaulting 3 years ago on a $274 million loan. Now, apparently, BlackStone is in talks with special servicer CW Capital for a possible deed in lieu for the hotel at 424 Clay Street in the financial district. Yep, you guys can look that up. Basically, a deed in lieu allows an owner to transfer a property to the lender and relieve it of the responsibility to be able to pay the mortgage debt. As BlackStone spokesperson said in the statement, they're cooperating with all parties involved to ensure a smooth transition of ownership. Translation, they're trying their hardest to unload this property as quietly and as quickly as possible. But hey, we see you, BlackStone. Don't think we didn't notice this kind of thing, right guys? So BlackStone is practically bleeding money from this asset turn liability situation. Their whole hotel portfolio talked about here had an appraised value of $360 million in October last year compared to $444 million in late 2017. In June, 123-year-old Club Quarters San Francisco had an occupancy of 58%. Another one, BlackStone has completely written off its stake in the 1.4 million square foot Playa District office campus in Los Angeles, and now the private equity firm is in talks with lenders about what to do with this property. And pretty much the same line from their spokesperson, talking about the challenges facing the property and writing this property down over 3 years ago and completely writing it off last year. It's a big mess. Just take a look at the property history with BlackRock, you guys. In 2016, BlackStone bought Playa District, located on a triangular piece of land wedged between Sepulveda Boulevard and the 405 freeway near Los Angeles International Airport for $583 million. 3 years later, the company called it a high-quality asset, one that it wanted to invest in significantly. Now, it's got about $482 million in debt. What's more, when BlackStone bought Playa District, the property was 82% leased. Now, the complex is about 70% leased, showing how BlackStone itself has pivoted away from office in recent years. And it's not just them. Former BlackStone subsidiary, now its own company, BlackRock, walked away from commercial real estate as well. Some say it's a clear sign that they feel like they're just too big to fail, and they're probably setting up for a government bailout because they know they can. So what do you guys think? Is this a signal that something is wrong here? Now, if you want more critical updates on real estate companies like this one, don't hesitate to show your support, light up the like button, and be sure to hit the subscribe button on our channel. It's totally free, you guys, and it'll definitely help us get more content out to you here on the channel. So thank you guys so much. So yeah, I wouldn't be so quick to believe BlackStone when they're saying things like the market is bottoming or it's the time to start buying. You never know. They may be just looking to unload more of their non-performing properties and assets. Am I right? So here's what BlackStone Incorporated President Jon Gray had to say about commercial real estate. That commercial real estate, which has suffered its biggest price declines in half a century, could soon bottom. For him, while it will take time, they can see the pillars of a real estate recovery coming into place. He mentioned Blackstone's 3 major real estate transactions in the past 2 months, including its $3.5 billion deal to take Canadian real estate firm Tricon Residential private. It's also announced a partnership to develop more data centers and a plan to pay $1.2 billion to acquire a 20% equity stake in $17 billion worth of commercial real estate loans owned by the now defunct Signature Bank. So yeah, we're seeing the association between Blackstone and one of the regional banks that went bankrupt last year. Coincidence? I'm gonna let y'all decide on that one. So Gray also mentioned there's $65 billion of dry powder to invest in this dislocated market. And what they're hoping to capitalize on here, what they call further buying opportunities in real estate, including single-family rentals and multifamily rentals. They talked about single-family homes for rent as a space that, because of the shortage of single-family homes, has been much stronger. Translation? Blackstone wants to own more rentals while regular Americans are already paying 40, sometimes 50% of their income on rent. Yeah, I'm not really sure how that's going to turn out great for those in the working class, but what about you guys? For some people, Blackstone's a name synonymous with profiting from turmoil. They've built a fortune by capitalizing on periods of economic hardship. Remember the savings and loan crisis? While banks were hemorrhaging money, Blackstone swooped in, using their first ever fund to snatch up apartment buildings at rock-bottom prices. Oh yeah, fast forward to the Great Recession, people were losing their homes left and right, and Blackstone, seeing an opportunity, launched Invitation Homes. They bought up foreclosed houses by the thousands, pioneering the institutional single-family rental market. We're talking foreclosure auctions at the start of the modern institutional single-family rental business. They even spun Invitation Homes off as a public company, further solidifying their foothold. I mean, a whole lot of people would love to see rents come down. The whole paradigm of rent being 50% of someone's income and banks saying that this is normal is a recipe for lifelong poverty. But I'm not sure if that's going to happen anytime soon with what Blackstone is planning. What about you guys? And remember guys, the commercial real estate sector is at risk of seeing its biggest crash since 2008, and that could slam US banks with up to $160 billion in losses. That's according to a new working paper from researchers at USC, Columbia, Stanford, and Northwestern assessing the impact of higher for longer interest rates on the commercial real estate industry and the US banking system. The paper looked at the Fed's aggressive rate hikes in 2022, which weighed down assets like stocks, bonds, and commercial real estate. It's estimated that due to declines in property values from real estate hikes, rate hikes, and remote works, about 14% of all loans and 44% of office buildings are in negative equity, meaning current values are less than outstanding loan balances. As a result, 10, maybe 20% of all commercial real estate loans could default, on the low end of what the default rate was estimating to be during the financial crisis, or I should say the Great Financial Crisis, and banks could see around $160 billion in losses. The U.S. banking system faces potential instability due to 2 major concerns. $1.5 trillion in commercial real estate debt is set to mature in the coming years. This raises the risk of widespread defaults and losses for banks that hold these loans. Rising interest rates could further erode bank profitability, leading to potential insolvency insolvency for some institutions. This is especially worrisome for some smaller regional banks with higher exposure to commercial real estate and limited capital buffers. Translation? Those regional banks could be in a lot of trouble. And with a lot of small business owners relying on these banks for their loans, this is definitely going to have a ripple effect on the economy. These risks are already impacting investor confidence. In August 2023, Moody's downgraded the credit ratings of 10 large and mid-sized U.S. banks and placed others under review, citing increased risks on bank assets. The potential consequences could be quite significant. A scenario where half of uninsured depositors withdraw their funds from struggling banks, combined with widespread commercial real estate losses, could lead to the insolvency, i.e. bankruptcy, of 31 to 67 smaller regional banks, at least according to a recent research paper. Additionally, another 340 banks could face insolvency due to losses stemming from higher interest rates, something we're still in thanks to the Fed's higher for longer approach. But going back to BlackStone, they're not all too confident in their performance, at least based on the recent earnings report. Sure, I'll admit they ended 2023 with a bit of a comeback. We'll just call it that. They beat analysts' expectations for the December quarter with profits up 4% year over year and 15% higher than predictions. Their total assets under management also climbed over $1 trillion, showing a little bit of muscle there. The stock price even jumped 3% on the news. But here's the catch, guys. While the headline numbers do look good, their core business, fees from managing all that money, actually dipped slightly by 2%. This raised some eyebrows, especially since the stock's high price tag relies heavily on the promise of those fees rolling in. Analysts are watching very closely in 2024. They'll be looking for all the signs that BlackStone can turn their massive pile of assets into bigger fees. If they can't, that high stock price might come back down to earth. So the picture is a bit of a mixed bag for BlackStone. They're pulling in more money and they're growing their empire, but their core business is a little bit sluggish. So whether they can actually turn that around and kind of justify their heavy price tag, this is going to be a key story to watch for the year ahead. Now, I'd love to hear you guys' thoughts on BlackStone in the comments down below. Do you guys think that they can turn things around? And hey, if you enjoyed this deep dive into the world of finance and real estate, be sure to hit the subscribe button and the like button if you haven't already. I'm always exploring the business world one company at a time. I'll see you guys on the next one, all right? Till then, take care.